Time now for our Wall Street Week daily segment and a focus on lithium in the EV space. No company has benefited more from that uptick in EV adoption than Piedmont Lithium, but things have changed a lot over the last few months. Keith Phillips, he's the president and CEO of that company. He joined David Westin earlier to dive into the company's third quarter results and tell us what that signals about demand in the lithium market. Let's take a listen.
We're a 7-year-old company, and in Q3 we had our first 2 shipments of lithium concentrate. So it's the first time we've had revenue. And even though lithium prices have fallen considerably this year, down about 70%, we were quite profitable. So we had 50% gross margins, earned 88 cents a share on an adjusted basis. Very pleased with that. So we're happy to be in the small group of producers. You know, the lithium business is in probably the third inning of its evolution. There are dozens and dozens of aspiring producers. We're now one of a relatively small group of actual producers with positive cash flow, which is a great feeling.
Yeah, well, congratulations on that. Go back to what you said about the fluctuation in lithium prices, because they really went way up and then came way back down. Should we expect that level of volatility when it comes to lithium going forward, or is this just because we're in the third inning?
That's a good question. I'd say the last 2 years have been unusually volatile. I wouldn't expect to see it again. You know, we had a slow market from 2020 through early 2022, and then prices rebounded and they went to levels nobody had seen before. So lithium hydroxide prices went up 10x over about a 10-month period last year in 2022, and they got over 80,000 a ton. They're now in the low 20s a ton, which is a more historical normalized level, I would say. So they're down 70% from that level. So a big up, a big down. I think right now the market is quite gloomy about lithium prices. I take that as a message that we're probably at or near the bottom and things can rebound from here. I'm not sure we'll see 80,000 again, but I do think prices over the next several years will average higher than they are today, maybe considerably higher, but there will be some volatility for sure.
How much of that will depend on the demand for electric vehicles? I know that China has done, at least temporarily, away with its subsidies. There was a drop-off in the demand in China for EVs. And there are reports that maybe some of the demand slowing down in the United States as well. Maybe people who wanted them already got them, and it's hard getting the second generation.
Yeah, it's a process. I think, you know, the cars that most vehicle companies have been making are the more expensive cars. You know, the big Ford F-150s, et cetera, some of the early Teslas, the Tesla Model S. I think the whole industry is shifting now to focus on more mid-range vehicles. There are only so many $60,000, $80,000 or more cars sold in a year. So that market, the EV business is doing really well in. The lower price models where a lot of the volume is a kind of project for the future. And with a couple exceptions, most of the incumbent automotive companies they haven't really got to the volumes yet where they've got their cost down to a level where they're competitive with internal combustion cars. Now, if you think about total cost of ownership, I drive a Tesla. I've had it for 6 years. I'm saving at least $1,000 a year on gas. I'm saving a lot of money on maintenance. I mean, I'm not sure people run those numbers, but these are very economic vehicles to operate, and I think the market will figure that out in time. So the biggest issue now, I think, is that China is the biggest EV market by far. It's been driving the growth for the last several years. Europe and the U.S. are now catching up fast, and as we just get to new levels of penetration in the U.S., I think you'll see the market become more balanced, and I think you'll see the U.S. take on a more important role, which is critical for us because that's our focus.
The fall in lithium prices, to the contrary, notwithstanding, there have been a lot of concerns that we actually will not have enough lithium as we really ramp up EV production and people driving electric vehicles. As you look at the supply chain for lithium, where are the major choke points?
Yeah, you know, the major choke points I've always thought were upstream on the mining side. That's still an issue. It takes a decade to bring a mine online. We've got a project in North Carolina, great project. We're in year 7 of advancing that project. We hope to get permitted next year. It'll take 2 or 3 years to build, so that'll be a 10+ year project. Now I think the bottleneck is on the downstream side. 83% of the world's lithium hydroxide, that's the actual chemical that goes into the battery, goes into the cathode and then into the battery. 83% of that is produced in China. The Chinese have gotten pretty good at it. They can build plants pretty quickly for low capital. We desperately need more plants like that in the United States and elsewhere. So there are 3 in construction in Australia. There's 1 in construction in Texas, a small one in Finland, and 1 in Korea. We have 2 projects we're going to build, 1 in Tennessee and 1 in North Carolina. We need way more. We believe we'll need 30 or 40 times more lithium hydroxide just in the U.S. by 2030 than we produce today. It's a big problem. These are big capital projects, and with interest rates higher, with capital cost inflation, and with now lithium prices softer, they're just going to be harder to build. So fortunately for us, we're focused on the U.S. We have the Inflation Reduction Act has some wonderful tax credits in it that make the projects that much more economic on an after-tax basis. And the loan availability from the Department of Energy's Loan Programs Office is also pretty interesting and competitive. So we'll be availing ourselves of those opportunities. But that's really what the world needs more of now, is more conversion facilities in the West.
So glad you raised the Inflation Reduction Act, because I was going to ask specifically, are we seeing the results of the Inflation Reduction Act yet? Because a lot of money is going out the door.
Yeah, it's interesting. You know, as you think about the money going out the door, the way the IRA credits are organized, most of the money goes out the door down the road only if somebody spends $1 billion or so to build a project, employ a lot of people, build a lot of lithium chemicals or cathode or batteries or cars. Until that time, there's no money going out the door. The loans and the grants aren't part of the IRA. So these are really, I think, well-designed programs where they're tax credits in the future. If you do all this and you ultimately become profitable and have a tax liability, there are some credits against it. In our case, it would be a 10% credit against our operating costs, which is quite significant. So that could offset a lot of our tax liability in the future. That'd be great. We only get that tax credit if we spend $1 billion or so, build the project, get it up and running, and are profitable. And I think it's a well-designed way to make it happen, as opposed to just funding the projects directly. So I think it's going to work well, and yeah, it's having a big impact. We know all the car companies, all the battery companies well. There are important battery plants and cathode plants being built in this country today that might not be here otherwise. They'd quite likely be somewhere else. So I think it's definitely been a magnet for investment.